This meeting is being recorded.
Welcome to the JDC West 2020 Finance Case Competition, sponsored by RBC. Thank you to our judges, Tay Kim, Randy Baldwin, Tracy Code, and Nicole Drysdale. Competitors will have a maximum of 20 minutes to present. Immediately following the presentation, judges will have a total of 5 minutes to ask the presenters questions. Competitors, you will see Zoom chat notifications at various intervals to indicate the remaining time. Any speaker who continues to speak after the maximum time limit will be stopped. No questions or comments will be permitted from the audience. All judges are asked to have their microphones muted during the presentation, and the audience is banned from any material or naming convention that bears the name or symbol of a competing university. We ask that the audience leave the Zoom call immediately following the presentation. Judges, please stay on this call until I advise you to move on to the next one. Competitors, you may begin your presentation.
It's not just about taking a bigger piece of the pie, but rather making the pie bigger. A quote from John Kubicek, founder and CEO of Engineered Assemblies. Originated in 2007, EA has seen significant growth and success since inception. The primary sources of this growth are due to its focus on being an efficient, innovative, and ethical company. By providing different company resources, as well as fostering community partnerships, EA has become an industry leader. And we look forward to showing you in today's presentation how being an industry leader can help you improve not only your company, but the industry as a whole. Today, we'll be presenting Reaching New Heights. My name is Allison, and I'm here with my colleagues Annika and Sohail from Clara Consulting. And thank you, John, and the rest of your team for having us here today. Taking a jump into our executive summary, we'll be showing today how you can take EA to new heights. Some of the key issues we'll be addressing within your company are how to stabilize your cash flows, how to increase your revenues and market share, and finally, how to finance these growth initiatives. Our recommendation for you today is Project SOAR. And this is involving having storage fees initiated, optimizing your networks, attaining capital, and finally, having a residual dividend policy. Through the details of this recommendation, we look forward to showing the impacts that Project SOAR can make for EA today. Annika will now take you through the analysis.
Thank you so much, Ali. Diving into the analysis. First, our problem statement. What is the optimal way in which engineered assemblies should allocate, manage, and finance its capital to remain an industry leader and increase the size of the market as a whole? Looking into the internal analysis, some core competencies. Your focus on quality and aesthetic, the aesthetic appeal and durability, which ultimately leads to decreased costs and increased energy efficiency, is your main core competency, as well as your philosophy of partnerships. One major area of improvement is the premium pricing model, which leads to stagnant revenues due to affordability. Some other areas of improvement we identified are the subcontractor installation, as well as the repairs on transportation equipment. The key takeaway: engineering assemblies has impactful partnerships and superior technology that has allowed it to thrive. Moving into the financial analysis. So there are a couple of signs of poor health. The major one we identified was the installation design ratio of 40%. So 40% of your customers are not using your installation service, which leads to increased revenues. So we would like to increase profit and brand image through our Project SOAR. Moving into the signs of good health, you have a year-over-year growth rate of 39%. And last year, your net income was 1.2 million. Moving forward into the external analysis, there are a couple of growth opportunities. The construction industry is growing exponentially. There was a 7.7% of Canada's GDP last year, and it has grown 18.1 billion in July 2021. Also, the branding LEED certifications, which lead to 25% less electricity and a 19% reduction in aggregate costs. The main key threats are macroeconomic through supply chain issues, through delays in receiving products and penalties due to the global disruptions, as well as correlation to economy and the increasing interest rate. The key takeaway is engineered assemblies operates in a continually growing market with macroeconomic threats. Moving into the construction industry at a glance. So overall, there is continued steady growth. 40% 5-year inflation adjusted growth is seen in the chart to the left. The construction industry is expected to grow from 2023 to 2025. Leading into the stakeholder analysis. So the main stakeholders are you, John, and your investors. Your key priorities are company growth, dividend policy, as well as securing the cash flows. Next, we'll look at the customers, which are the heavy industrial, institutional, and commercial, whose key priorities are quality, price, longevity, and product life. Finally, the creditors, whose priority is having the principal payment within every 90 days. So you are the main shareholder within our solution. So looking at your objectives, the growth of the facade industry, how can you increase the pie and grow your business? How can you stabilize cash flows, stabilize supplier expenses to mitigate currency risks, and appropriately allocate capital within your company? So the main business objectives are maintain a strong brand reputation, strong financials, and become an industry leader that ultimately effectively operate whilst being a socially responsible organization. Engineered Assemblies is a leader in the construction industry, ethically paving the way for others to thrive. Ali will talk about our alternatives.
Thank you so much, Annika. So jumping into the alternatives of what we potentially looked at for your company before coming to Project SOAR, and what are some of those foundational issues that we looked at? The first thing to consider is what is your decision criteria at EA, and what's the most important thing for you to be considering at this time when making such big company decisions? The first decision criteria we outlined is profit. Selecting an alternative that creates the most optimal profit for you, John, as well as your shareholders, is the key to an optimal solution. Second is growth. This is one of your key focuses right now, and that's why pursuing a strategy that allows EA to increase your market share, as well as the market as a whole through being an industry leader like we talked about previously, is so important for your company. And last, brand reputation. Fulfilling the mission that you, John, have chosen to unite the house of design and the field of construction, but in an ethical and socially responsible way. Taking these 3 decision criteria, we come back to the first issue we tried to tackle today, which is how should EA address its volatile and unpredicted expenses, especially with the recent supply chain issues that we've seen due to the pandemic. The 3 different issues or potential alternatives that you could use here is firstly to initiate storage fees. Currently, one of your biggest blocks within your supply chain is that you're having to store materials for longer durations because your clients are unable to take them at adequate times. If you were potentially to initiate a storage fee where your customers would pay per month for storing their materials over the predetermined date, this could potentially increase your profits, support your growth as you would have additional revenues, and also protect your brand value because it protects you to maintain the clients that you currently have. And we recognize that customer retention is extremely important. Other potential alternatives you could pursue is to use local suppliers rather than the suppliers you use in Europe. However, because you have particularly patented technology and direct relationships with these suppliers, we don't believe that this would support growth as we are unsure that the quality would match your current quality. And last, to increase prices. This could potentially provide more cash flow as you would have higher margins and better ability to cover your expenses. However, it doesn't support growth because this does not allow you to maintain your current customer base and really focus on that customer retention. Because of that, we can see that the answer for your company in order to address its volatile expenses is to initiate storage fees, which will allow you to have higher cash flows. Taking a look at the second issue we addressed today, which is how can EA increase revenues and its market share by being an industry leader? We looked at 2 potential options here, and the first is external revenue growth, which you could do through your RTS acquisition. Your second option would be to use internal revenue growth, and this could be seen through installation sales. So we'll take you through what these 2 options could potentially look like for EA. Firstly, taking a look on that external side into the RTS acquisition, our company did an analysis using a football field valuation seen on the left in order to determine if this company was over or undervalued. As you can see, using a EBITDA and revenue comparable models, as well as using a DCF, we can see that the overall valuation of RTS is overvalued within the market with a $3 million asking price and an intrinsic value of $2.8 million. Because of this, we can see that it's not necessarily a profitable opportunity for EA. Taking a look further at the qualitative side of pursuing this acquisition, we see that you could potentially have synergies with this company if you were to pursue it through sales as well as salaries and administration. However, this company does utilize kickbacks with its clients in order to pursue most of its revenues. And because of this, you would have to account for potentially a 25% loss of revenue if you were to move away from this kickbacks. As we've mentioned multiple times in today's presentation, remaining an ethical company and an industry leader is so important for EA because it's the foundation you've built your company on. And because of that, we believe that moving forward with RTS would not allow you to maintain the ethical standards that you have within your company. You would have to remove those kickbacks. And because of that, we can see that if so, to do that, the costs would exceed the benefits, as you can see here with our table turning. So coming back to this decision, moving into our secondary option of potentially doing those installation sales, we can see on the left that currently for your installations, 60% of them are done by subcontractors rather than your proxy cladding. If you were potentially to pursue key improvements, such as an extended warranty option and flexible pricing in order to remain more competitive within the market, this could potentially increase in your revenues through installations. As we see, every 1% in installation increase is a 2.5% increase in total revenue. So this would be a very profitable investment. Coming back to those decision criteria, we do see that promoting the installations allows you to increase profit as well as support your growth and protect your brand. While if you were potentially to acquire RTS, this does not protect your brand value as it doesn't remain true to your company ethics. Because of that, we recommend you move forward with promoting the installations. And lastly, taking a look at how would you finance this and that last key issue. We looked at 3 potential alternatives. You could finance through debt, potentially a combined debt and cash as well. And then lastly, an equity option. As you'll see later in the presentation today, our recommendation only requires a low capital expenditure. And because of that, we decided that the best option for you to move forward with was to pursue the option that had the lowest cost of capital in order to really promote profitability. So between these 3 options, we recommend you moving forward with funding your projects through a line of capital as well as cash. And Sohail will take you through a little bit deeper what that will look like and how Project SOAR can help you reach new heights.
Thank you so much, Ali. So moving on to Project SOAR, what exactly is it? Project SOAR will help you reach new heights and become that industry leader in an ethical manner and basically maximize your profitability through storage fees, optimizing networks, attaining capital, and a residual dividend policy. So moving on to the first segment, storage fees. So we're addressing our volatile and unpredictable expenses. You can see to the diagram on the right that there is a delay between supplier payment and customer payment that ultimately costs you heavily. This delay is often due to construction projects that are delayed on the client's behalf. So thus, we recommend that you implement a late storage fee for clients affected by these delays. A penalty of 5% of order value per month can yield up to $83,000 per month. This is way above and beyond the $32,000 of interest you originally paid last year, and thus incentivizes clients to collect their products earlier. Moving on to optimizing networks. So how can we increase revenues and market share? We already discussed why RTS is not a viable solution for you, John. It's not in line with your brand reputation, it's not a profitable opportunity. And thus we recommend you should pursue internal growth instead. This focuses initiatives on synergies between EA and proxy cladding and incentivizes consumers through extended warranty and flexible pricing to choose proxy over other subcontractors. As you said, one bad install will do more harm than 50 great installations. So how to control this risk? Best is to use your own subcontractors and use proxy cladding to ultimately mitigate this risk. Moving on to our third recommendation, how do you attain the capital for capital expenditures that you are seeking to pursue? Well, first, you can utilize the $1.5 million available from the line of credit and cash to fund these capital expenditures, whether it's to replace vehicles, which we'll get into a little later here, or meet short-term cash needs. The biggest drawback to this is just paying off the line of credit principal within 3 months of borrowing, which is not a problem for you because you have a comfortable cash cushion. Now, the last part of Project SOAR, which will really help you become an industry leader in an ethical manner, is really attacking the residual dividend policy. So here we recommend that you apply a 5% residual dividend policy consistently moving forward. So we also recommend that you do buy out the 5% of your brother Paul's shares for $600,000. And this will ultimately help the capital allocation the best and help pursue what's best for the interest in the company. So along with Project SOAR, we've identified that it's the most viable option out there. Well, what else can we do? We can look at the volatility of foreign exchange rates, and how do we mitigate that? We can use derivatives to lock in the exchange rate using currency swaps and future contracts as well. Next, moving on to purchasing trucks. Through an intensive analysis that we have in our appendix, we can show that selling the current trucks and buying outright a new fleet for yields an MPV of $328,000. This will minimize the losses for EA. Third, the invoice changes. Accommodation to large clients is of the utmost priority to you. So adjusting the Ontario and Alberta invoices by 100K is the best option for you to pursue. Lastly, charity work. We recommend that you allocate 50% of your budget to the Canadian Association of Women in Construction and clients, and this will ultimately have the biggest impact on the community. So moving on to implementation, this is where Annika will take you through a step-by-step detailed process of how we will approach Project SOAR.
Thank you so much, Sohail. So looking at our implementation timeline here, starting in the first half of 2022 and going to 2030, we have divided it up into 3 different phases. Starting with phase 1. The first activity is implementing a storage fee, which is the Department of Finance's job. This will gain 5% of storage value per month at $162,000. The ultimate impact of this will be to fund the supplier fees and storage costs. The second activity is to hire a legal team to address the transfer of Paul's shares. The impact of this will be legal fees for John to personally buy out his brother's shares. The last activity is to purchase a new fleet of trucks and sell the old fleet. The ultimate impact of this will to be get rid of the depreciated assets. This option yields the highest NPV. Moving into phase 2, the first activity is to utilize a line of credit at 5.5% to meet cash needs, done in the second half of 2022 onwards. The impact of this will be to fund capital expenditures as well as bridge the gap between AP and AR. The second activity is to establish new residual dividend policy. Completion second half of 2022. The impacts will be shareholders approved dividend policy and investors paid 5% on 2022 profits. The third activity is to incentivize customers to choose proxy cladding, done by the second half of 2022, and implementing extent warranty and flexible pricing options for consumers. Moving into phase 3, the first activity is to hedge FX rates utilizing derivatives. This will be completed in the first half of 2023, and it will be impactful by avoiding volatility by securing a rate of 1 Canadian to 0.688 euro through the use of currency swaps and futures contracts. The second activity is to implement future consideration, such as charity donations. This is done when we'll impact through swap invoices for clients and implement a new charity allocation to CAWIC. So some risks and mitigations. The first 2 most important risks that we identified were the loss of clients due to late storage fees and employee backlash from invoice changes. In order to mitigate this and to move the likelihood down on the graph, we negotiate expected completion date on a legal contract and no effect to original commissions. There are other risks and mitigations listed below that we identified. Ali will talk about some of the impacts.
Thank you so much, Annika, for taking us through the implementation. So jumping into the impacts, we come back to the initial key founder objectives of you, John, and what your key goals are at this point in time for the company. And remaining back to these, we see that one of the initial goals was growth of the facade industry, increasing the pie and growing the business. Through our recommendation today, we've shown that you'll be able to grow the business and increase your cash flows. Additionally, we looked at stabilizing cash flows and what this could look like for your company. And potentially these are different things that we've addressed in today's recommendation. Jumping into the financial impacts, we see that through Project SOAR, EA will be able to have a $9.3 million cash fund by the end of 2022, as we see the cash flows here on the right-hand side. Some of our financial assumptions are below, and I look forward to going through those further later if you have any further questions. But coming into our last impacts of today's recommendation, we take a look at the KPIs, which is first, revenue target of $33 million by the end of 2022, a dividend payout ratio of $83,000 by the end of 2022, fourth quarter, a storage fee revenue just for 2022 of $162,000, and finally, a target increase in Praxis market share of 20% by the end of 2025. As we review the quote that we started today's presentation with, it's not just about taking a bigger piece of the pie, but rather making the pie bigger. And this is what we intend to do for you, John, through our recommendation of Project SOAR, allowing EA not only to take a bigger piece of the pie and improve its market share, but also to remain an industry leader and improve the market as a whole. Thank you.
Okay, we'll now move on to the Q&A session. So Nicole, you could go ahead.
Perfect. Thank you for the presentation, everyone. So I just wanted to quickly go back to where you were talking about brand reputation and how important it was to John. But at the same time, we recommended that he adjust the invoice for the larger client. Do you think that would, if the employees found out and as it affects their commission, do you think that would have a reputational risk?
First of all, that's a great question, Nicole, and thank you so much for asking it. Ultimately, when we were addressing his reputation and the reputation of EA, we believe the reputation was at the biggest jeopardy when it comes to the use of kickbacks. So that's really why we emphasized no kickbacks, no RTS acquisition, because that will really hurt EA's profound brand reputation. Now, addressing onto your question, we actually believe that, let me just pull up the slide here, that, sorry about that. So that the invoicing will actually not have that resounding effects, because we have made precautions in our risk and MITs that there will be no change to commissions because of the actual change in invoices. So ultimately, what we can conclude from this is we've addressed in our risk and mitigations that there might be employee backlash from invoice chases, but ultimately by having no effect on the original commissions, this will have no resounding effect on our reputation, and will uphold those standards that we hold John very highly to.
Thank you.
Okay, we can go with Randy.
Thank you. My question was related to the buyout of Paul's shares. I'm curious how the $500,000 value was arrived at.
Yeah, so we can definitely go to the appendix. So we did a bit of a valuation on the company using the EBITDA 5 model. And then we found the value of the firm to be $11.8 million. And then we simply took 5% of that to find his payout because he does have a 5% stake within the company. So these are our financials.
Okay. And you're suggesting that John actually buys Paul's shares, correct?
Yes, he buys it with his own money, not the firm's money, correct?
Okay, thank you.
Okay, Tracy.
So I love the angle of assigning a cost to what you expect the kickbacks are actually adding to the bottom line of this company, and as a result, what it does to the valuation. So there's definitely no right or wrong answer here. I'm just wondering what made you use 25% as the amount that you think sales would drop if kickbacks were removed?
That's a fantastic question. So given the information that we've pulled about RTS, one of their main key core competencies was the kickback and how that allowed them to retain more customers and ultimately grow their business at a faster rate, potentially even than EA. And because of this, we believe that 25% of potential revenues being reduced through the amount of kickbacks is a relatively conservative number, considering that a majority of their revenues do derive from this specific aspect of the business. And because of that, we felt that 25% was a conservative estimate that gave us a good estimation of what this potential revenue loss would look like while not being too aggressive.
Great, thanks.
I got a couple of questions, but I'm just gonna go with one here. So I guess finding the revenue streams would be important. How is charging more? I think you said charging more to the customer it would help retain the customers. Like at the end of the day, like thinking about charging the customers for the storage fees, don't you think it would be better to negotiate some kind of payment terms with your suppliers? Wouldn't that be a better decision than charging your customers?
Yeah, that's a great question. And actually looking at the storage fee, it's not really a deterrence to customers. Why? Because we're not actually penalizing them if they were to arrive on time. What we're really penalizing is the thought of their construction delays impeding on EA and their resources, the storage costs that they incur because a client has customer delays. So from that, we can like conclude that a delay between like the supplier and the customer payment is what costs us. Renegotiating supplier terms could be beneficial, but we believe that the best way to do this is really eradicating that penalization because of customer delays through a storage fee.
Okay, thanks.
So that concludes this presentation. Thank you, delegates, for your presentation today, and have a good day.
Thank you so much to all the judges for your time. Have a great rest of your day.
Thank you.
Thank you.
Thank you.